Welcome, everyone, to this week's episode of the Inveniam podcast. Today, we are talking about the dynamics of digital exchanges. We have some very fascinating guests with us today, as well as some familiar faces from Inveniam. We're looking forward to this very exciting topic, and I cannot wait to introduce you to our guests and the knowledge that they're going to share with us. But first, if we could just kick it over to Rick Bunker, Inveniam CTO, to lay the stage of what we're talking about here. Rick, what is a digital exchange? What constitutes a digital exchange? Where did this term come from? Why the distinction?
Well, if we go back, it's not a bunch of people meeting underneath the tree on Wall Street to do open outcry in person and trade stock certificates, right? Over time, we've moved to virtualize more and more of the activity of an exchange. And the primary function of an exchange is to help buyers find sellers, sellers find buyers, and to find a price, to discover a price, right? And I know that there are many people on this call who build and run exchanges, and they have to do so many more things. And I don't mean to trivialize any of that work. But when it comes right down to it, it's find the other side of the trade and figure out the fair price, right? That's if an exchange doesn't do that, it's nothing. That's the prerequisite for all activity. As we do it with more and more things that are just on computers and computer ledgers, we start talking about them being digital exchanges. So if you go in to Paris, into the Paris Bourse, it's just a big empty room where they have cocktail parties now that used to be full of people shoulder to shoulder used to be pieces of paper, and then it was handheld computers to enter the things. And there used to be ticket runners running the orders back and forth. I don't know how many of the people out here are old enough to remember that stuff like me, but it was the real deal. And now it all moves electronically. And as we talk about securities, which are themselves native to blockchain, native to the internet, if you will, finding ways, building exchanges to help create markets for their primary issuance, that is, when the company wants to sell part of itself, or secondary trading, when I say, I've got too much of the King of Prussia shopping mall, and you want more of the King of Prussia shopping mall, so we trade. They become more and more important. And the two overarching observations I have is that blockchains have been built in many cases, and we've got some exceptions on here who can talk about it today, but in many cases have been built from the ground up with skepticism about institutions. So they're built for self-custody. And that creates all sorts of complexities for trade settlement in a world that's used to everything being custodied by a broker or by a formal custodian and transacted at DTCC, right? So that's one thing that's different and new and has to be addressed. And the second is, and this is very near and dear to my heart, is that we're talking about putting a lot of things out there for buying and selling, which are not public securities, the closed garden, the walled garden of just a few public securities with well documented and described and formally presented to the world information about them. So if we think people are going to buy and sell these things, we have to help them understand what it is that they're considering buying and selling and help them figure out what it's worth. And that's our role in this whole mess. But it's pretty exciting.
Got it. Thank you, Rick. So I'm going to just start kicking it around. But after I start kicking it around, feel free to jump in, anyone that has anything relevant to say. So I want to start with Ira Miller from Provenance. So Rick took us through a very interesting timeline of how this has evolved and the various capabilities and features and increases in value that have been unlocked by these innovations over time in exchanges. But he talks about exchanges where you are offering things that aren't just public securities. So can you tell us what he's talking about?
Sure. So I think one of the things that's interesting in sort of like the larger DeFi space is that there's been a lot of other assets that are not securities that have been traded and exchanged. And it's that tension because there's a lot of things that feel like securities in the space, and there's a lot of regulatory uncertainty. So I think that's an interesting tension there because I would say that the DeFi crowd doesn't really want to deal with a lot of the regulation that's associated with that. They built up a lot of that kind of self-custody, the peer-to-peer, the not needing some of this extra ceremony, but it's also hurt a lot of people. And so that distinction there, the lack of rules, the coming in from that side, I think, we're sort of reining that in a little bit. And I think, Provenance is trying to walk kind of a fine line here because we're semi-permissioned. So you can come in and you can do some of these things in sort of the open DeFi way that are not restricted. If it's not a security, you should be able to exchange that. But we're also trying to bring in the side where there are securities, there are rules, there's custodians, and we need to make sure that those things are enforced.
Got it. That's a very helpful answer. So I'm still a little worried though, Evangelos. I'm concerned about how such an exchange might, not Provenance, of course, which has very robust controls, but just a digital exchange in general that would keep that whole process under control. How do regulations play into this?
Yeah, I think Ira's comments were spot on. There are digital assets, cryptos, let's say, versus digital securities. Oasis offers a FINRA-regulated broker-dealer and an SEC-registered alternative trading system, an ATS, to transact in digital securities. So that's sort of where we're parked in this ecosystem. And from our perspective, we follow the rules of the law to ensure that these guardrails that Ira referenced are in place. And there are also downstream impacts. It's a matter of accessing the platform, transacting, maybe maker and taker on both sides of that trade, coming to a meeting of the minds. But downstream, there's, for example, trade and transaction reporting. These are all elements of an exchange that are necessary when you're talking about digital securities. And, from my perspective, not all digital assets are digital securities, but we do handle digital securities trading at Oasis Pro.
Got it. Evangelos, you mentioned an interesting word in your description. You said ecosystem. So I would love to hear from Shari on this. What is Evangelos talking about when he says ecosystem? In this context, what does that word mean?
Yeah, and I mean that's exactly what I was thinking about when Rick really kicked it off and then handed it over to Ira. But when you think about 30, 40 years ago, you had the runners, but you also had, your annual reports got mailed to you. So this instant data accessibility, as well as more data inputs, are a critical component. Just like, when we started the pandemic, maybe fast forwarding a few decades, people were very comfortable with signing on electronically, whereas 20 years ago, they may have needed, to see the piece of paper and sign it, themselves. So having all of these components now digitized, whether it be the electronic signature, the, price inputs and data feeds, whether it be, payment rails, all of the digitization around the core exchange or the core trading capability really were prerequisites to be able to now have a process where you have an electronic interface, you're signing documents electronically, you're being able to see your positions and being able to transact with them. And also, I think critically, being able to see more rich data around to support your decision. And what that's going to do as let's go back 30 years again. Sorry if anyone's getting woozy with all of the different timelines, but let's go back 30 years again and talk about, the New York Stock Exchange or NASDAQ when the electronic trading world came in, when that infrastructure started building, you had then this introduction to, the automated market makers and folks that were taking in data and pumping it out. So you had sort of people investing based on fundamentals and people investing based on some type of, arbitrage or some type of model. And that then created a much more rich environment, much more rich trading environment, and also increased the velocity of trading. It then led to the creation of more products, ETFs, new products like that. So in this private world, what I'm really excited about is looking at how digitizing this flow within a regulatory framework. I think, Evangelos, you're absolutely spot on, and it's definitely harder than it sounds, but doing that in a regulatory framework on an alternative trading system like Oasis Pro or like Rialto Markets then allows you to get to more, by digitizing it, you can get to more and different investor bases. So not just, selling 1 million shares of XYZ to, a very large investor at a certain price point, but being able to sell it to diverse investor bases. And then it creates a really dynamic ecosystem that then feeds on itself and creates that velocity of trading and the ability to create new products.
Wow.
So hopefully that was helpful.
That was very helpful. But asking us to go back 30 years, I'm now back in kindergarten. So I would like to kick this over to Kevin Cuddeback, our chief data scientist at Inveniam, who can provide a little bit more experienced view of this. So digital exchanges in the current modern context, in the last 10 years or so, what advantages do they offer that did not exist previously? How has the game changed, so to speak?
Well, I think we already saw that just in, the early online, the Web 2 features of just anybody could see the order book on either side of the traded price. Just the idea of seeing the orders stacked up on either side, pushing that kind of information out to anyone who wanted to participate, that was sort of revolutionary. I don't think we should forget, though, that in that world, the things that Shari mentioned, which is there still had to be an annual report, there still had to be, things that supported the prices that people were, choosing to trade at. They did it on the basis of some considered judgment. And I'm going to ask, has the world, maybe this is too softball a question, I think the world has been grossly misled by Uniswap into thinking that all you have to do is show up and trade. And like Uniswap appears to be an automated alternative to exchanges, but I would say it only works because prices are coming from someplace else. That if there was only Uniswap, it would fail. Or it would be limited to things that had sort of arbitrary speculative values. And so I'm gonna I kind of want to kick it to the exchanges and ask, has the world been misled into thinking that the features that Uniswap offers, instantaneous settlement, non-custodial trading or self-custodial trading, are those good things? Are they misleading things? Are they appropriate technologies, that we should be expecting from exchanges? Or is it the other way around, which is people have been misled into thinking that all they need is a Uniswap?
Yeah.
We're going to get to that in 1 second. I just want to remind our audience that if you have any questions, feel free to drop them in the comments right below here. We will get to them. We'll devote 10 minutes or so at the end to fielding questions for the group. One thing I want to point out, and I'm going to get to Julian, and then I have a very special question for Nick. When we talk about how progress has occurred in global markets on rolling out digital exchanges, both from a regulatory perspective and adoption and all that, there's wildly different scenarios based on where geographically in the world you're talking about. So given that Julian is coming to us pretty much from the other side of the world compared to everybody else, Julian, can you give us your perspective on kind of the international view of this? Who's leading the charge? Who's falling behind? Where is this more developed? Where is it less? Just your insight would be very useful.
Yeah, thanks for having us, and good to see everyone again. Well, I'll try and summarize. I mean, we have the equivalent of an ATS on our InvestX platform in Singapore. There's not a lot of activity because that requires licensed market makers, but it is the model of the traditional exchange order books matching engines. I think there's a lot of important points about that as well. Typically in any market, they only service the biggest assets, and 99% of people are left with nothing, right? So Uniswap, in my mind, is an incredible innovation. Do I think it's everything is needed? Yeah, I do. I mean, it was proven in the development of the AMM model, which essentially is smart contract to cryptocurrencies, start a liquidity pool, fast, cheap, anyone can join. It brought liquidity to the decentralized exchanges, which before that AMM model was thousands of altcoins with no liquidity. And then the top crypto were in Binance and Coinbase because they had all the money. So whether you like or hate or think the Uniswap model is enough, it's the only thing available to most of those assets if you go back to 2017, 2018, and it's still today. If you want to launch a cryptocurrency on Binance, they want $1 million listing fee and hundreds of thousands of dollars of liquidity. If you only have a $100,000 raise from your token, it can't be done. You can take that to Uniswap. So what we did at IXSwap, which is our other platform, is build the Uniswap for real world asset token. Then it's built for the 99.9% of real world assets that are never going to be welcome in an exchange. They're not big enough. They're not exchange traded. So I think it's just two completely different systems for two completely different types of assets. And I think it's going to serve if we all believe that real world asset tokens are going to be in the tens and hundreds and millions eventually. Well, they just won't even fit in exchanges, full stop. But then if you can give a guy with a $5,000 equity token an ability to start his own liquidity pool, that's game changing, and that works for everyone. So I think the purpose of it is more important than how it works versus the traditional model.
Yeah, that's a very good point. So last but certainly not least, I want to go to Nick. We've heard from our entire panel about a seemingly future-looking vision of how digital exchanges will change global capital markets or are changing global capital markets. How far away are we? Are we 5 years, 1 year, 10 years, 100 years? When is this tide of revolution actually gonna crash?
Yeah, that's a great question. I think the important thing for folks who are listening in is that, and you've seen some of this with some of the participants today in their companies, like this stuff's available today. We can, the community and the participants in the ecosystems that Shari was referring to, like the technology's there, the regulatory clarity is, to some degree there for a lot of stuff, and projects are moving forward. So I think the important thing is to, get involved if you're working in, a financial institution, or you're, working with, an investor community through a broker dealer, start talking to the exchanges, come and talk to some of the communities. We have a very active community ourselves, the Polymesh Association. Like people are very, very quick to point you in the right direction and get traction. I think the thing that has really changed and opened my eyes up since coming into this space, being based in Canada, working with the big 5 banks, like that is all you hear about. It's very similar in Australia and other markets where you're, not quite the same in the US. We have a lot of banks, but in most countries there's like 5. And that's all it is. Like nobody talks about anything else. It's just that bank, what's going on with that bank over here, that bank over here. But in our ecosystem, like you just hop on a Discord and like in 5 seconds, somebody's connecting you to somebody in another part of the world that has an idea or an angle on a project. And very rapidly, just as fast as everybody took money out of Silicon Valley Bank, people can come together and point you to a project, and all of a sudden you do have enough liquidity to get things going. And hopefully, if you're using, blockchains that are able to do some of these things at a much lower cost, it isn't going to require a significant amount of upstart capital to get it going.
Yeah, thank you for that insight, Nick. I want to use what you said as a jumping off point to kind of open it up to the entire group. So I've been in DeFi for a long time. Like most people who have, it's been a hobby, and then a curiosity, and then an interest, and then all of a sudden a career. So one of the interesting phrases I always heard was, "There's no bankers on Discord." And so I want to open up to the broader group here. Are there kind of different micro ecosystems that are interacting, competing, inspiring each other, pushing each other forward, holding each other back? When we talk about the dynamics of digital exchanges, I think one of the most important dynamics is the participants and all of their various goals and motivations. So if we could talk a little bit about that, who are the real most interesting participants within the dynamics of digital exchanges? Where do you see the most movement right now, since you're all on the ground dealing with this every day? Don't everyone volunteer at once.
I guess I can maybe kick that off. So as an alternative trading system, it's really barbelled from my perspective in terms of what we see that's interesting and that we think is moving the world forward. On the one hand, are those really forward-leaning large asset managers like the BlackRocks, like the Wisdom Trees, like the Franklin Templetons, that are putting their money where their mouth is and actually doing things digitally and launching products and working on projects there. And then and obviously that supports the innovation and gets other people interested. And then on the other end, what we've seen just an amazing resonance with is this concept of community-based projects that really rally a community around something, whether that be music rights or movies or other things that are community oriented. And so we're seeing a lot of marketplaces and issuers dive into that space and create a really vibrant community. And with the digital security element, you can have some really interesting twists and activate those communities in a much more meaningful way. So those are the two areas we're seeing, but Evangelos and Julian, please comment.
Yeah, I'll add from my perspective. I think Shari is spot on with regards to the larger institutions, these global names that we're all well aware of, starting to get involved. They also have the distribution, so it makes it a much easier proposition there. From our perspective, I think Rick was the one that mentioned early on in his comments walled garden. I don't think that's helpful to anybody, and it's not accredited to the ecosystem. So I think there's an opportunity here for exchanges, and if I'm talking specifically about digital securities exchanges, and where we're sort of seated at Oasis Pro, I think there's an opportunity there for us to, rather than hinder liquidity opportunities, there's an opportunity to work together with other exchanges to enhance that. Because if somebody's at Oasis Pro, they may not necessarily have an account with Rialto or InvestX, and now we're talking about cross-jurisdictional. But when there's an opportunity to reach across a spectrum and mutually participate together, I know there are regulatory and compliance considerations, but that just enhances the opportunity for liquidity to go cross exchange, to be able to bring in more participants who may be willing to be on the other side of a particular trade, right? That's important as well. They may not be at Oasis, but they may be at Rialto. So how do we work that dynamic into place rather than just sitting in our own walled gardens?
Yeah, just a very quick interjection. I apologize for not being clear. When I talked about the walled gardens, I was talking about the New York Stock Exchange and NASDAQ, right? The publicly listed securities where you can't go on to the New York Stock Exchange and trade anything that isn't one of their listed securities. That's what I was talking about with the wall.
Where the SEC is the wall.
Yeah, not the different DAOs. That's not what I meant.
Ira, what do you think about all this?
I think it's kind of an interesting line because, I'm coming at it mostly from a technical background. That's kind of my background here, but there's an analog because we're talking about communities, and I think one of the things you have to recognize in the blockchain world is that the fundamental way that it works is by consensus. So there, by definition, is a community involved. And sometimes you're worried about validators or other things, but fundamentally, the people who control the network are the community. And so you want to have a community that's aligned, that has kind of similar thinking, and can agree on the direction for the network, that can agree on the direction that the thing is going. And then another aspect of it that kind of came up is that blockchains are very limited in terms of their capacity. So fundamentally, you have to be able to interoperate. So you've got both communities where you're working together, and then fundamentally from the technology angle, you're going to have to work together with other areas. You're going to have to partner. And so I think it drives a really interesting relationship because you do need that communication. You need that ability to work together, and you need to solve that also at a technical level, because eventually you'll hit these hard constraints. And so you can't put those kind of hard problems off. You have to solve them up front.
Do you think that creates a barrier to entry for participating?
I think it can a little bit. But it's not necessarily a barrier because there's a lot of different communities out there, right? I think, Provenance likes to focus in kind of a narrow niche in financial services. But if you're looking for something that doesn't fit within our community, there's a lot of other communities out there. So I think, that breadth of different available areas to work in means that it's not that limited, because you could go and work with a community that fits with the thing that you're working with and then start working together.
Julian, what are your thoughts?
When the industry began 6 years ago, a lot of people did their own private thing. Kind of the walled garden approach, which was really just trying to focus on efficiencies using blockchain, but it wasn't very interesting. It didn't really work. I mean, the real evolution recently has been, for the industry, has been, and people were issuing security tokens and they were doing it on their own private chains or not, or just in their own setup, but there was no change of access and there was no real change in value for that actual token. So what was kind of the evolution in the last 12 to 24 months is that, people started issuing real world asset tokens, security tokens, real world asset tokens has been rebranded, and tokenizing treasuries, money market funds on public chains. And then people with crypto could buy them. And then you started to see the whole DeFi world waking up to the concept of digital securities and real world assets as a real use case. So I think depends on which asset. Is it financial instruments? Is it private equity? Is it startups? It really is very, very diverse with all these different assets. Our position was always, we're never going to try and compete with BlackRock or Wall Street. We're going to build not towards them. We're going to build towards DeFi. We're going to build all on the public rails. We're going to build these. We're going to take the innovations of crypto and see if we can use them for securities and try to make it legal compliant. And eventually we're going to distribute all these assets on cryptocurrency exchanges. The real competition, I think, moving forward is for the banks is cryptocurrency exchanges, because they're just going to keep adding all these assets, just like banks added all those assets. So our take on it is that all of this innovation and brain power and new assets, and there are new assets, right? NFTs were new, memes were new, DAOs were new. That's going to go on forever. And so the only way you're going to create the next ETF and the next securities products is if you're on those same rails, because that's where the innovation is, and that's where the energy is, and that's where the brain power is, and they will interact with all those other tokens. So again, it started very closed walled garden. A lot of those platforms failed if you go back to 2017, 18. And then now it's very diverse. There's people doing their own walled garden approach, and there's also a need to stitch everything together, right? Because it was also if you're going to try and issue a real world asset token and you need a broker here and a custodian there and this guy, and they've got 4 different protocols, it was too hard basket and threw it all out. So ours and other platforms here and elsewhere, Oasis Pro, they've tried to stitch it all together so at least you can get it all launched. And then again, if we're all on these chains that are connected, then at some point we will see that real world asset startup token or real estate issued on 5 platforms around the world, and we'll see some sort of global liquidity, and hopefully people will be using IXSwap for some liquidity as well.
Perfect. So I want to follow up on that. You mentioned security tokens. So, the format that I like to follow is I kind of am very beginner friendly for the first half hour before we dive into the weeds. So giving people a proper warning. So Nick, if you could give us an overview. When Julian says security tokens, can you explain A, what they are, and B, the innovation that they represent? Take us right from the transition from beginner friendly right into the weeds.
Sure. Yeah. It is a very loaded word. I'll say that, and it depends where you are in the world and what regulator you're talking to and what they mean. But I think when I think of security token, to me, it is just a security that embeds the information that you would find like in a prospectus, essentially into a tokenized form, and then it is a security token. And it is the same type of regulatory requirements that are applied in the traditional sense, just applied in a tokenized fashion. And so what that means is if I'm a custodian or I'm a dealer or I'm another participant, I should be able to read the token and get all of the relevant information out of that. So it's creating a much more data-rich environment, and it reduces a lot of the cost associated to get that information, because before a blockchain existed, you would literally have someone thumbing through a PDF, right? And you have like everybody in every back office, middle office around the world doing the same thing, going through a PDF and inputting it into a machine. Well, that creates a really expensive system. And so if you can get that information off of a token, and this is what we're working with some custodians, and I had one custodian even say like, okay, I can just read all of that information. I can understand the provenance of that token, like where it came from, how it came into being in existence, who issued it, what venue did you get it from, and the chain of custody from when that thing was created. Is like, well, that actually solves a real problem for me, because if I've got a private asset that somebody issued in a jurisdiction, in South America, all of a sudden they come to me and like, hey, can you custody this for me? And he's like, well, as a custodian, I got to do like these 3 things before I can accept it. And that's really hard, because who do I talk to? Like the lawyer that issued it in a jurisdiction, maybe it's in a language I don't understand. So the security token takes all of that heavily, really, really, regulatory data, embeds it in the token, and standardizes it in a way that it can be read in near real time, and people can make decisions based on that.
So to the group, is this particular technological feature living up to the hype?
I want to piggyback off of what Nick said with regards to the underlying asset, and I'm going to probably sound like Pat O'Meara here, but marking that asset to market more frequently will drive, for us at the exchange side, more transactions, right? That's what we anticipate. And not only that, market dynamics then come into play. Historically, these private markets, these alternative investments, were very opaque, and you didn't have that supporting information. Now that it's there, that makes all the difference. And that makes these assets, listen, I don't think these private markets are going to trade the way public markets trade. It's not going to be ultra high-end frequency trading. But at the end of the day, the opportunity for liquidity is what a lot of investors in these private markets are looking for, and we'll be able to offer them that through the likes of Inveniam and the real-time data that you're bringing in and marking the asset more frequently. That only benefits the exchanges as well, and downstream opportunities.
And if I can just add on to that, I completely agree. And I think it's not just marking it more often, but having more detailed information. So not just the P&L, but the rent rolls, electricity usage, like all of these other data elements are going to give traders the information that they can use to build differentiated models. And if you can provide that information to, a certain set, I know we talked about liquidity a little bit earlier, and I hate saying liquidity because it's if you have $100 million issuance, it's just inherently not going to trade, like IBM trades, because the market cap is just smaller and it's just different. But if you can get either the large issuances to trade, or what you can do by digitizing it is allow it to get bundled with other things and create other products that then can maybe be sliced out in different ways. But the data definitely allows both the fundamental trader as well as the, what I call market makers, or traders that I don't like to use the term market makers, but liquidity providers, or traders that are trading via model. It gives them that data that they need to differentiate themselves.
That's a really great point, Shari. At this point, let me kind of just give some context here. So in addition to being a part-time volunteer podcast host, I also, lead our AI division. So we've seen a lot of progress with getting AI to get that underlying data and inform the underlying asset value of a token. And I talk to a lot of AI maximalists who just think that the AI is good enough. And it isn't. It's not accurate enough. It's not relevant enough. It doesn't have enough domain knowledge. It's just out of the box, not quite good enough. So, there's been a kind of a culture for decades of being disappointed by things that claim to be AI. And it turns out that blockchain represents a very interesting mechanism to keep AI compute accurate and under control. I want to go to Kevin for a second. So blockchain offers a lot of mechanisms for keeping data security on point and under control, and keeping asset value credentialed. And can you talk a little bit about the progress that happened before I got to Inveniam on blockchain and tokenization and informing asset data?
Right. Well, I mean, it's kind of like we realized that that blockchain was that yin waiting for the yang of AI, and we were sort of building in advance of the solution. But I mean, Rick loves to talk about we're using blockchain the right way, and always have, in the sense that we're using it. If you had a globally community curated distributed database, what would you store on it? And the idea of storing the underlying data, or the proof of the underlying data, the footnotes. And so we thought of blockchain originally as a great place to store footnotes, to keep that big banker's box full of documents that gets slid across the table at an asset transaction closing, to digitize that, and then once we had it digital, to keep it ever fresh. And just that idea that you had data that you wanted to release and keep ever fresh, that's the progress we had made. But we hadn't solved the problem of really, we knew that we were going to be faster and cheaper than the $300,000 4-month diligence process. But, just being faster than that, there were no prizes. Where we really needed to be faster and better than were people's everyday processes. And that's where I hand it over to you, Albert. We had this thing. It was going to be good for storing infinitely deep footnotes, that later, when people wanted to, people were always asking the question, when was the last time a real attorney looked at this deal? When was the last time, a real auditor checked these numbers? And we were prepared for that question. But it still sort of assumed the expense and time of an auditor and an attorney to read things out of contracts. So that's what happened before you arrived, Albert. But we were waiting for the AI that you and Nick have been describing.
Got it. So thank you for that history lesson. So now I want to kind of fast forward to a future vision. I'm going to go to Ira. So let's say that we have tokenized real world assets, of course, hosted on Provenance. And they get a constant data feed of the underlying value of the asset, let's say for a commercial office building or a fund or anything. What value does tokenization provide for real world assets that otherwise might not be available to that asset owner?
So I think there's some really interesting things that have been coming up in this conversation. You talked about a box of documents. You talked about passing things around. You talked about people doing things with it. And the real efficiency, I think, of a blockchain is that it's deterministic in the way that it processes data. If you can vet the process and you can see that there's a certain set of inputs, you can see that it's going to be the same at the end, right? And what I mean by that is if I push a box of documents across the table to you, if it's been tokenized on the blockchain, now you can know that everything is complete, that all of the things are there, or that anything might have been modified. And so I think that the real world asset piece is going to be extremely powerful just because of how clear it is about what data is in there. Do you have the correct data? Who's changed it? When has it been modified? Like, when was the last audit? Oh, this one's been audited, and we know the process. Therefore, we can trust the result without re-auditing it. I think there's just a ton of efficiency that can come from how a real world asset can be tokenized on blockchain.
I think the just from the business perspective on that, like, we're working with partners now, and they actually see a way to change the capital structure for these things. So that's where it really gets interesting. Like, as Shari alluded to before, if you've got some activity in these tokens because you have a smaller ticket size, there's a market price for this asset. Now, in real estate, like, it's all about leverage in real estate, right? Like, tokenize, it's debt. Debt drives real estate. And so it's about how much leverage can I get for this? Well, you're reliant today on a bank's appraiser. Now, if you've got a market price for this asset, what if I tokenize 10% of my building? Am I going to be able to get a higher market price that I can go back to my bank and say, well, no, the building's worth this? All of a sudden, am I getting more leverage now than if I hadn't sold that amount to tokenize it to set a price that otherwise would have been determined by an appraiser, who the bank's probably doing all, you know what I mean? Like, you don't know, right? And so can I actually increase the amount of leverage that I'm getting to go buy my next property? People are figuring this out today. And the ones that do are going to have a durable competitive advantage. And if you can start to create an advantage in your capital structure, like, that's a big moat, right? That's like Warren Buffett size moats. And somebody is going to do this, and they're going to win big because they're just going to be able to drive more leverage out of getting this done correctly. So I think that's really what's in it for what some of the people that we're working with are really interested in. And then obviously, because you're slicing and dicing it, you're going to get better distribution because you're bundling these things for folks. And so can I do this in a, at a smaller ticket size for a wider investor base? That's going to feed into my community. They're going to get really excited. And then if I can figure out how to do this in a cost-effective way, can I take this overseas through a Reg S? And people are trying to, it's still a little bit expensive. It's not quite tested at distributing Reg S widely, but there's a lot of people with a lot of money figuring it out. And once you start to build those pipelines, you're going to see a much broader distribution for these types of assets in that, sort of through that mechanism.
Yeah, Nick, with regards to the real estate comment, that can go both ways, I suppose. It can end up being a positive for the owner, or alternatively, it could ultimately be a negative. But nonetheless, historically, the opaqueness and lack of transparency has, I think, ultimately hindered progress. And in this case, it can benefit probably more than not, which is great. And it's true and accurate. It's nothing's being hidden under the covers. It's all out there, which with all this data, and to Albert and what he's doing at Inveniam, all this data that we have today that historically wasn't accessible, there's really ways to pull that in and extend that out to those that are prospective investors or existing investors that just want more more clarity on the asset. So just my
Got
2
it.
cents there. Yeah.
No, that was helpful insight. So at this point, we're going to open it up to a few questions. So if you do have a question, as a reminder, just go ahead and put it in the comment box below, either on LinkedIn or YouTube. We'll be able to get it. So we are actually going to start with a question that came in for Kevin. So Kevin, welcome to the internet. Somebody thinks you're wrong. And we have a question from Andy Singleton here. Can we get that up on the screen? He says, Kevin, I respect your analysis, but you're wrong about Uniswap. A quote, liquidity pool offering, end quote, where all of the proceeds go into Uniswap works without CEX is an innovation. So it's your floor, Kevin.
I'm not going to say it's not an innovation. The question is, how widely applicable is it if there aren't price signals coming from someplace else? In other words, could Uniswap work if people weren't? Actually, this is kind of a question back to Julian, which was, could Uniswap work in really thinly traded things? If you slow Uniswap down, would it still work? Or is it only working because it's able to reference prices from coming from someplace else? That's kind of...
Yeah, no, I mean, it's not only working because it's referenced from somewhere else. I think the real question is for each asset that's listed is how much liquidity is going to be there. I mean, you can start a liquidity pool on our platform with $10,000, $5,000 equities and 5,000 USDT, and you've got a liquidity pool. It's not very deep, but hey, without that, you got nothing. So it keeps going back to, I think it's going to serve an entire wall of assets that would never get on a centralized exchange. And they're evolving. Uniswap's V4, we're V1. And the V4 is like, a Ferrari versus the push bike of one, and they'll probably collide over time, the sexes and the dexes in terms of how they work. And even in Singapore, we've got the regulators here saying, do you want to bring your AMM into Singapore? Because that was actually built offshore. Because there's no market making solutions in the real world asset exchanges. So there's not even a choice. So I think it's really just more about the depth. And then, some liquidity is better than no liquidity. But again, the history of Uniswap proved that ABC coin even started at $5,000. If all the crew here eventually put it in, and eventually the pools got so deep, and eventually now Ethereum and USDT liquidity is deeper on Uniswap than it is on some of the biggest crypto exchanges. So it's actually, in some assets, it's even bigger, or deeper, I should say. Yeah.
Got it. So I think we've dealt with that.
Well,
question.
if I'm wrong, then the exchanges have something to fear, or tell me tell me what. I mean, is this a if you can't beat them, join them moment?
I honestly think over time, the centralized real world asset exchanges will all have AMM models, and the old school market making model will change dramatically. But they will all bring in the AMM because it'll allow them to add a lot more assets that wouldn't get market making anyway. So that's what I think is going to happen. I think it'll become an additional part of the centralized exchange, a traditional model, I guess, because it brings more assets.
All right, Kevin, you're out of the hot seat for the moment. So our next question
hello, Andy.
Came in early, and Shari, I believe I saw at the Tokenize This conference in Miami last week. So where this was a pretty hot topic about regulation in adjacent industries. Tom, can we get that question up, please? The question is, how would stablecoin regulation or ETH, ETF affect tokenized RWA or security tokens broadly? How does AI affect this potentially? Really, anyone could answer this one. There's a lot to say here.
Yeah, I mean, I can step in. I think it's really moving those to within a regulated framework. Obviously, there's going to be a lot of agitation from the moving of it, but we've had conversations over the years. I mean, all the way back to dare I say utility tokens, like 2017, 2018, about what does it look like to divest that, put it in a security wrapper, and allow the investors to come back in. What does that process look like legally from a regulatorily compliant perspective? So we've had those conversations before, and I know people get really excited about this topic. So I'm going to leave it there in terms of my comments. It's possible, and I'm sure Oasis Pro, I'd love to hear your thoughts as well.
Yeah, I'm not going to answer the question what's a security and what's not a security. I know where we participate in the U.S. as a regulated broker dealer and an SEC registered ATS, we actually offer trading in security. So I'll be the first to tell you a lot of these other assets are not securities, and they may trade as such, but there's a venue for them. That's not our venue. That's not my venue, and that's not Shari's venue either. They'll trade and transact elsewhere if they're not securities.
All right. So I actually want to pose the last question, then we'll go ahead and go around the group for final comments. My question is this: what innovation do we still need? What's missing? What are we really looking for? And the innovation could be regulatory innovation, could be technological innovation, could be just adoption, or customer acquisition innovation, whatever it might be. What are we still waiting for to continue unlocking value in this space?
I can start, Albert. From my perspective, it's standardization. It's interoperability. It's a better user experience, one that resonates more so, especially with those in the TradFi space. And yes, regulatory clarity. Even in our world, regulatory clarity is needed. So I think we're making good progress on some of those bullet points that I just referenced, but even more progress is needed to get things moving at a greater speed.
Good point.
I think I might just pop in here and say, from our perspective, it's use cases. So we're seeing sort of the money market use case, which is great, and that's a really investable asset right there, and then on the other end, really different types of investments. But it really comes down to the investment. If the investment is not really that attractive, you're going to have a hard time unless you kind of catch one of the tailwinds at generating real interest in it. So it starts, that's table stakes, starts with the investment. And so getting more interesting use cases around that.
Got it. What else?
I was just going to say, I think the key to one of the keys to crypto's growth was that everyone could buy it. And I think the complexities of identity, like the KYC identity, I think that's probably one of the biggest bottlenecks, because you do need good assets and you need the UX, UI, you need the technology. But if we can get to a point where you can just plug in your wallet and then everything you need to say immediately translates into this platform and that platform, and the asset and the token go into it, that's when I think everything's going to change. But there's 4 million KYC companies out there, and every single time it still feels like a bit of a mess, and everyone's got their own versions and different fields to fill in, and every time you register on anything, it's a pain in the butt. So I think that would help us, but I think that's still far away.
Ira, I think we were going to jump in.
Yeah, so I think a couple of things here, building a little bit on what Julian was saying there regarding KYC. I think there's a play, like Provenance tries to build some of these things into the protocol. It gives us a little bit of the standardization that Evangelos was talking about, right? If you've got something that defines how KYC is going to be represented on a chain, and you can build capabilities on top of that, it's going to make things easier. Stepping back and thinking about the ecosystem as a whole, there's been a few things that have come up during this panel. Questions about how do you determine price, and how do you determine kind of the information behind assets, and this is great because there's all this data and all this stuff that proves what the provenance of an asset is. I think as we go forward in an industry, what's really going to happen is we're going to get these layers of abstraction that make it easier to understand and work with this data. And part of that comes through standardization. Part of that comes through just more building, right? I mean, obviously, as a builder, I like to go back to building, but I'm just going to say that we need those tools to deal with that data. So on Provenance, you can have a digital asset that's got a ton of information behind it. I heard from one of the people at Figure the other day, they have 17 terabytes of data behind their HELOCs that they put on chain. And I was like, that's amazing. Also, how do you deal with all that? And I think solutions like the AI angle, the solutions like making that more transparent to improve price discovery, I think all of those kinds of things are in our future. And it definitely looks good as we go forward.
That's a great insight. We could do a whole episode just on that. But unfortunately, we're almost out of time today. So I'm going to go around to everyone. We're going to do reverse alphabetical order for the final word. I just want to hear the last final word from everyone. So Shari, you are up next. And just so no one has to say the alphabet in their head, Nick, you're up after.
Reverse alphabetical, and first name, last name. Anyway,
First name. There you go.
Perfect. No, I think, this is a really interesting space and constantly evolving. And, as we look back, and I call it, 3 to 4 years, I do believe we're starting to see the beginning seeds of real traction. And we're going to reach that tipping point where things move very quickly. So that's really what I'm excited to be here and participate in. We've been at this for 7 years, so obviously I've probably been thinking it's going to be sooner than today, but I really do believe we're starting to see some of that early traction that then gets more traction.
Perfect. Nick?
Just get involved. You said earlier there's no bankers on Discord, but all your remote working engineers are, and they're trading crypto nonstop. So if you're a leader, talk to those folks, understand what's going on. And if you're one of those folks, reach out to your communities and the associations behind them to help you connect with the leaders to see how they can get involved. I mean, it's just that simple. Like, there's technologies here. Get connected with folks that can help you drive innovation in your own organization, and start doing stuff, because that's often where we see the real innovation happen, when people start trying to solve the problems that they're put up against by people who are saying no.
Right on, Nick. Kevin?
I'm going to pick a fight with the comment section. Now, I've been trying to be a little provocative on the what is Uniswap's role. I want people to check out Julian's site, info.ixswap.io. And to look at the assets there, there's an opportunity for liquidity providers. These are, maybe I'll ask Julian when he goes to describe these assets, but in other words, this should be working. This should be working big. And are there challenges? I challenge people to participate in Julian's market, and I challenge the rest of us to think about what our role in solving some of those things are, or adopting them.
So, Julian, I don't know what you bribed Kevin with, but
my
go ahead and double dip.
My final word is everyone just needs to listen to Kevin. Done.
There you go.
No, it was
All
great.
right.
But seriously, it's new, new products, new assets. Everything's evolving. The only way to really get a real skin in the game is put some skin in the game, buy some stuff, and play around with it. I think anyone who's in crypto has had a pretty interesting personal journey on how it all worked and how it learned. Same thing here. Maybe not as crazy, but I think you've got to touch it and feel it and get involved and join the ride. Thank you. Thanks for hosting.
True. Ira?
I think that, I just kind of want to double down on the fact that there's another 16 trillion in assets that's coming our way. And the way that it gets here is by reducing friction, by learning lessons from the partners you're working with. I mean, Provenance works with Apollo and Hamilton Lane and Figure, and we try and understand their use cases. We try and bring them together. We want to drive that friction out. That's how we win. We build these tools to make things better. And I think that's where we're headed.
And drive you certainly are doing. So Evangelos, go ahead.
Yeah, just going back to the topic at hand here, complexities of digital asset exchanges across multiple jurisdictions. From my perspective, I think we've figured it out on primary issuance, working with partners like InvestaX and others. On the secondary trading side, we're making good progress, and I think we're going to get there. It's just going to be a little bit of a longer road, just because of some of the challenges on the regulatory compliance side and cross order book. But we are going to get there, and I'm feeling really confident it's going to really empower a lot of investors who historically, weren't in a position to be. So, yeah,
I think we would all agree. So unfortunately, that's all the time we have for today. I want to thank all of our guests for joining us, and of course, our entire audience for watching. Thank you for tuning in to this episode of the Inveniam podcast. We will see you next time. Bye, everyone.